And just like that, the first half of the year is over. It's been quite the year on Wall Street. We've seen a lot of interesting developments, including some turbulence around the world. In fact, global stocks had their worst first half of the year since 2010. Fortunately, things have been a little bit better here in the United States, where we did see some of the small caps doing well here recently. We also see the NASDAQ up about 9% year to date, led higher by some of those FANG stocks. So there are a few patches of strength here and there that we're going to constantly try to seek out for you here on the market outlook. In fact, tonight I want to kind of display a new tool that I've been working on exclusively for Market Scholars Premium members and kind of guide us towards one of the sectors that's in an outperforming state right now. So with that, let's go ahead and get started. Welcome to the Market Outlook video. I'm your host, Brandon Van Zee. It's June 29th, 2018. First of all, if you're new to these videos, we'd like to say thank you for checking them out. Also, we'd encourage you to subscribe to our YouTube channel. You can also leave us comments and look down in the description area for a link that will allow you to sign up for our daily emails that would entitle you to not only the announcement of these videos being available every day, but also the overbought and oversold cluster signals within the S&P 500. In addition to YouTube, we're also on Twitter. I'm at Brandon Van Zee, all one word. Market Scholars is at market_scholars. And we would encourage you to like and retweet the tweet where we talk about the Market Outlook video. We usually pin it to the top of our profile. In addition to Twitter, we're also on Facebook. We'd encourage you to join our group there. You can see the web address on the logo on the screen in front of you. So with that, let's go ahead and dive into some analysis on the markets here. As you can see, I've got the S&P 500 pulled up in front of us. We still have that bearish posture using the intermediate term line on the market forecast tool. Now remember, that market forecast tool is down below here. It's this tool that has three different colors is the main part of the tool. You've got green, which is the intermediate term line. We've got blue, which is the near term line, and red, which is the momentum line. We also overlay the market sentiment line in that dotted orange back there. We don't refer to that all that often because it's not very sensitive to trade movements, but it is back there for those of you that want it. But the main line that we look at here is this green line that you can see clearly is in a downtrend at this point. It broke through this 80 upper reversal zone here. So on this particular tool, 80 is the upper reversal zone, 20 is the lower reversal zone. And generally speaking, when that green line goes down and through 80 like it did back here on about June 21st or so, June 22nd, somewhere in that time period, we do go to a bearish posture at that point. And you can see we've kind of struggled since that time period to kind of unwind that bearishness. Prices did attempt a bounce here in the last couple of days. Yesterday was a decent move for the market. Today wanted to be a decent move, but you can see even that left us kind of wanting more, at least if you're bullish on the markets. You can see here that yes, we indeed did close a little bit higher today. We were up 2 whole points on the S&P 500, but you'll notice from your candlestick analysis there that that is not the best looking candlestick on planet Earth, right? You generally are looking at something like that as a candle where you close basically at session lows. So yes, it's nice that we were up a touch from yesterday's close, but we were down significantly from the open and also from the intraday high here today, which tells us that investors probably weren't all that confident going into the weekend. So we'll see what Monday brings, but as of right now, we do retain that bearish posture on the market forecast tool. Let's go ahead and take a look at our next chart, which is our 4 grid, where we look at 4 different indices using that market forecast posture as well. Remember, this is chart 4B for those of you that are following along at home that have gone through my tutorial video on this already. Remember, that's available exclusively to Market Scholars Premium members, which, as a reminder, that subscription is going to go up in price starting on Sunday. So for those of you that want to join Market Scholars, I would highly encourage you to do it either Friday or Saturday before prices go up. But anyway, as you can see here, all 4 of our indices here in the United States do retain that bearish posture. You'll notice here the S&P 500 has that darker pink color there, which tells us strongly bearish posture. We also have the strongly bearish posture here with the Dow Jones Industrial Average. We also have it here for the NASDAQ, and I sound like a broken record because we also have it here on the Russell 2000. Now that one is new. Remember, as of last night, it was just a weekly bearish posture, but we had enough pressure on the markets here recently where that green line down below did go below 50. Remember, if you ever want to zoom in on any of these charts, you can just right click and then go to maximize sell. So here's the Russell 2000. Remember, this is the index that tracks the small caps. This is a 3-month chart that we're looking at right here, and you can see it's done well over the last 3 months. Yes, the last week or so has been a little bit rough, but all in all, small cap investors have had something to smile about here in the last couple of months at least. But as you can see, right now is one of those cautionary periods where we have that bearish posture. And we have that green line that dipped below 50 right there just as of today. And so that's why you see that lighter pink background go to that darker pink background to signify the fact that we went from a weekly bearish posture to a strongly bearish posture on the Russell 2000. Let's take a look at a few more charts here. Let's take a peek at our 1040 crossover method in this case. I just want to see how we wrap up the week. Remember, this particular chart setup right here will deal with weekly candles. And so when we're using something like a 1040 crossover method, it's important that we kind of look at it at the end of the week because, you know, the candle that's forming, if you were to look at it on Monday, there's still 4 more days before that candle gets formed. Now that it's Friday and the week is in the books, that candle at the end, all the way to the right, is officially formed. And so as it stands right now, we are seeing some market pressures. There's no doubt about that. It's part of the reason we put these little red arrows on the charts as well, where we can signify that price went down below the 50-day moving average, or in this case, the 10-period weekly moving average. Remember, the 10-period weekly moving average and the 50-day moving average are effectively the same thing since there's 5 trading days in each week. So you can see right here, we do have a red arrow from that perspective on the S&P 500, and we also have it on the Dow Jones. However, down below, the NASDAQ and the Russell 2000 do not have those red arrows. So it just shows that they're holding up a little bit better. They're retaining some of their strength a little bit better. Now, as you can see, the background colors of all of these charts are still green. So that signifies that we still have the 10-period moving average above the 40-period moving average in each of these cases. But in the case of the Dow Jones, it is getting fairly close. So that could end up going to a bearish posture at some point in early third quarter here. We'll just have to see what the market gods bring our way. And if there is additional weakness and bearishness, then you might expect the Dow Jones to finally give a bearish posture from this longer term perspective, which it has not had since way back here in March of 2016. Let's go ahead and take a look at a sector 12 grid here. Actually, this one is, well, let's just stick with this one right here. This is actually your line chart. So this is a little bit different. These are still the sectors here. So you'll notice up at the top, I've got these labeled and color-coded according to the lines here. Now, this is chart 4H. For those of you that are following along at home. And this is a 1-year chart that shows up by default. But remember, you can change that to whatever time period you want by coming above the chart, clicking on your time frame setup, and then just choosing whatever alternative time period you want. So I want to look at the 6-month, considering the fact that we are now 6 months into this year, just to kind of get a sense of, you know, how have these various sectors done year to date at this point at the halfway mark of 2018. Now, as you can see, XLY, which if you don't know what that is, again, refer to the labels up here at the top in orange, is discretionary. So a lot of retail stocks have done very well this year. Some people left them for dead, but they've come roaring back. And of course, it doesn't hurt to have a couple of high-profile stocks like Netflix and Amazon that are part of the discretionary space as well. Of course, those have been a couple of the best performing stocks in the entire market here recently. Technology is in number 2 spot year to date, but be aware that it has fallen quite a bit here recently. Technology was a leader. You can see here the red line over here that I'm kind of circling was well above this orange line at the beginning of June. So it really wasn't until this month where we've seen kind of a switch of sector strength up there at the top. And now we're kind of being led higher year to date by discretionary. And tech is starting to show a little bit of wear and tear. And I might show you that here in a little bit as well when I highlight that new tool that I referred to before. Tech had been a stalwart for years and years and years, and we're starting to finally feel a little bit of weakness coming in there. So So we'll see if it leads to something further or not, but just be aware of that. We do have energy as our number 3 sector year to date. That's XLE right there. And the oil patch has been an interesting place. It hasn't been the smoothest of trades, I'll say that. It's kind of been a wild run, but it has largely been to the upside. So energy stocks remain in vogue. On the bottom side year to date, we still have those staples. Notice the staples are down 9% year to date. Now that does not include any positive impact that the dividends would have had. Right now you could probably say that the staples are yielding right around 3%. And so on a half-year basis, you could probably add a 1.5% back to that negative number right there if you wanted to include the dividends. But anyway, the staples have shown some nice resiliency in the last month. They're one of the best performers in the last month, even though they're the worst performer in the last 6 months. So keep that in the back of your mind. This is actually a nice little bottoming pattern that we've seen here with the staples. So we'll see if that can lead to some second half of the year strength right there. Let's kind of take this idea with the line charts here, comparison charts, and let's take that now over to the asset classes and kind of see what they're doing in the last 6 months as well, since we're kind of sticking with that theme of year-to-date performance. And as you can see, when I pull up the 6-month chart here for the asset class comparison, it's not even close. I mean, oil is just crushing everything else in its path. So that's your big orange line that you see up here up at the top. USO, if you use that as your proxy to kind of get a sense of what oil has been doing, is up about 25% year-to-date. So that is a very healthy move out of oil. In second place, we do have IWM. That's a small cap arena that I mentioned before. They're up about 7% year to date. So that's been a healthy place to hang out. And of course, David and I have been referring to the dollar strength time and time again during these videos in the first half of the year. So you can see that the dollar is actually in third place from an asset class perspective. It's even beating the S&P 500. You don't see that a whole lot, but dollar's actually had a very strong trend. On the downside, as I mentioned before, worldwide stocks have really struggled this year. EEM, which is going to track the emerging markets, places like China and India, Brazil, Russia, etc. That's down 8% year to date. So pretty ugly there if you're a foreign investor at this point. The place to have hung out and weathered the storm so far in 2018 has been the resilient markets here in the United States. Hopefully that continues to be the case. Let's take a look at another chart here. Let's go ahead and look at the international comparison chart. Now this is going to be 4M for those of you that are following along at home. And let's switch this over to a 6-month view here. And as you can see, the entire direction of these trends look much different than everything else we've looked at so far. Remember, this is looking specifically at foreign nation stock markets. So up here you can see the various ones, Brazil, Russia, India, China, etc., etc. And notice how most of those are in a downtrend, right? We were looking at the US-based sectors. Most of them were, well, I should say about half of them were in kind of an uptrend. And even from an asset class perspective, we've seen plenty of uptrends. But here, you're going to have to work pretty hard to find any sort of semblance of an uptrend. The vast majority of foreign stock markets are really struggling right now. So we'll see if they can kind of turn things around in the second half of the year. Maybe for those of you that are more value-oriented investors, you can find something there. But if you are a momentum-based trader, these have not been the best place to be looking for opportunities here recently. You can see that as we apply the S&P 500 with the United States here, it's actually the leader on this board on a year-to-date basis. S&P 500 is just above the flat line. It's up about 2% year to date, but basically all the rest of those lines that you see down below here are down in price year to date. The worst performer is Brazil by a long shot. They were down about 21% in just the first half of the year. Remember, most people think of 20% down as a bear market. So in other words, Brazil's in a bear market right now. Sometimes we get a little myopic here as investors in the United States. We don't recognize that there's some areas of the world that are in a true pain train right now. We should feel fairly blessed here in the United States that we haven't had to deal with that quite yet. And who knows if that's around the corner. But right now, what we do know is that the strength is not in the foreign stock markets at this current time. One other story that was kind of interesting this year is the yield curve. So Let's go ahead and pull that up. Here's our yield curve chart. This is chart 4J. This is a pretty special chart. You don't see this in many other places. And so for those of you that are Premium Market Scholar subscribers, remember in my welcome email that I send out to you, there'll be a link that'll give you a tutorial on how to upload all of these various unique charts that we've created for our premium subscribers. But anyway, you can see that the last time we had an inverted yield curve would have been back here in 2007 time period. I'm kind of circling it here in the middle of the screen. Notice we can see that in two different ways visually. First of all, you can see these lines, these colored lines up here bunched up together. Now remember, these are all your U.S. government bonds, but at different maturities. So notice up above we have 3-month treasuries, 6 months, 1 year, 2 years, 5 years, 10 years, 20 years, and 30 years. So an inverted yield curve is when the security is doing something that you would not assume that it should do. In other words, the shorter term durations are yielding more than the longer term ones, which is not normal. That is not how the market should react functionally for long periods of time. But you do see it occasionally when we go through some hiccups in the economy. Now another way to see that is down below here, we have our 10s-2s spread. And notice that when the blue line comes down here and goes below that pink line, which represents the 0 line here, it basically means that at those brief moments in time, the 2-year treasuries actually yielded more than the 10-year treasuries. Again, that's very rare. You don't see that very often. Well, since that time, of course, we've had a financial crisis. Sometimes inverted yield curves can actually lead to financial crises. So we've had that in 2008 and 2009, and things started to normalize a little bit out of those time periods. But notice where we're at right now. That's been one of the stories of the year. Notice that the 2s-10 spread down here is flattening, flattening, flattening. We get this blue line coming closer and closer to this, this pink line down here that represents the 0 area. So what that means is all of these lines up here are bunching together tighter and tighter, and the yield curve is getting flatter. So keep that in the back of your mind, because that's not always the best environment for banks, and that's been one of the stories of the year as well. Banks have just gone through a really, really rough patch. If we go back here to just chart 4A, the banks, so let's pull up, how about KBE will get us done. Notice the banks. I mean, these things have just been beaten over the top of the head. We thought today, finally, the banks were going to get a little bit of a relief rally, because as many of you are aware, some of the CCAR results came out last night, where the banks basically have to ask regulators permission on their capital allocation plans and whether they can raise dividends or do big stock buyback programs. And most of them pass with flying colors. And so yesterday in the after hours session, we saw a number of those banks flying higher once we heard that news. And so the prevailing wisdom was that today was going to be a great day for the banks. And it seemed like it was going to be at the beginning of the day. Let's just take a peek here at Wells Fargo. Wells Fargo actually ended up being one of the better performers, but even it sold off from its high levels. Notice this long upper shadow here on Wells Fargo. It was still up 3.3% on their announcement of their raised dividend, but it sold off quite a bit by the end of the day. Let's take a look at a few of the other big ones. There's Citigroup, same thing. It closed up on the day only 4 cents, but it was all the way up here to about 69 bucks at its high of the day, and it closed below 67. Let's take a look at JP Morgan. JP Morgan, look at that ugly candle right there. It looked like we were going to break out to the upside this morning, and we closed near the session lows there. And then, of course, let's not forget about Bank of America, and yikes, that's one of the ugliest candles that you're going to find on a chart. That is a bearish engulfing right there if you've ever seen one. Right? Again, thought we were going to break out to the upside here. Everybody got excited this morning, and then the sellers came in a big way and pushed the banks to the downside. That's generally not perceived very positively by markets. A lot of times, strong markets do have a healthy component from the financial sector, and right now, they're just showing them no love right there. We're actually seeing a lot better strength out of the real estate area rather than the banks and other traditional financial companies. And again, a lot of that goes back to what's happening with the treasury market and the yield curve right now. So Anyway, an interesting first half of the year, without a doubt. Again, small caps and tech stocks have been a couple of the places that you can hide out a little bit, but otherwise it's been a little bit choppier of an experience for investors here this year. A couple things I wanted to address before we get into our trade announcement. Or the, I shouldn't say announcement, but the application example. First of all, this is our final week of discount pricing at Market Scholars. And so remember, we've been announcing this for a long time. I know you guys have bared with us while we have discussed this recently. I promise it won't be like this every week. We'll get back to more heavy analysis in our videos, but we don't want to be accused of having people tell us later on that, hey, I didn't know you guys had the discount, because there will be no exceptions to our discounted offer. We've been telling you guys about this for a long time. Well, we're finally in the final stretch here, and boy, oh boy, have you guys been coming through. We've been seeing so many signups here in the last 3 days or so. So thank you to everybody who is new to Market Scholars Premium program. But anyway, we do get a lot of questions since we've just mostly been in a beta period since March teaching our classes. A lot of you don't know exactly what do we teach at Market Scholars. So just wanted to highlight this here real quickly as far as the types of classes that David and I teach every single day. On Mondays, I teach my top-down trend trading class. That's where we look for strong trends within sectors and industry groups and then apply that to the strongest stocks within those areas. On Monday nights, I teach my options for long-term investors class, where we focus on selling puts on high-quality dividend stocks and also selling covered calls. On Tuesdays, I teach my dividend growth investing class, and so that's where we look for stocks that are growing their dividends for long periods of time and look to enter them at attractive time periods when their yields are above average in the historical range. On Tuesday afternoons, David teaches his directional option strategies, where he speculates a little bit more using options and actually picks a direction. It's not neutral-based trading, so there he's looking for trends and different bounce setups. On Wednesdays, when he teaches his very in-depth inventory trading class, and of course that's very in-depth options trading where he's dealing with iron condors and diagonal spreads and calendar spreads and everything else, and managing that inventory over time to try to generate alpha. On Wednesdays, I teach my strategy lab class. That's where I paper trade 50 different trading strategies against one another and then pick up different things that are taking place in the market based off of what we're learning through that process, and of course placing trades in there as well. On Thursdays, I teach my question and answer session where students can ask me about their favorite stocks and what my opinion is on those stocks. On Thursday afternoons, David teaches his portfolio management with ETFs class. So he's kind of managing that with kind of a longer term mindset, more of a 401k mindset, but doing it through the form of more diversified ETFs. And then on Fridays, David teaches a technical analysis class where he gets into all kinds of fun things, whether it's you know, the CCI or the Bollinger Bands or even this market forecast indicator for those of you that want to pick up some more detailed analysis on it. And then on Saturday mornings, David teaches his question and answer session where students can ask him questions about his various classes and then also ask him about their favorite stocks. So just wanted to give you a rundown of that. I know sometimes people have a question as far as what we teach and how much we teach. You can see here we teach tons of things. We're busy all day long teaching our premium subscribers. So that's one thing that you can certainly look forward to. Another thing you can look forward to, of course, is all of our charting scripts that we've built and customized over time. There's over 26 of them available now. You see a lot of them when we're in these presentations here together. And so that would be a nice benefit that you would receive as well. And of course, we'll continue to build even more charts in the future. Another benefit that you're going to have is that this particular product, the Market Outlook, is actually going to be changing to a degree in the future. We are going to place we're going to place our trades and do our trade management of the Market Outlook trades in a live setting for our premium subscribers before the market closes. Now, the benefit of that is we get our trades filled. How many times have we tried to place a trade here at night when we're doing these videos and come to find out the next morning that the market's already moved away from us and we don't get filled on our trade? Well, if we're doing a live presentation before the market closes, that can ensure that we're going to get filled on our trades much more often. But of course, that gives our premium subscribers a nice benefit as well, because they're going to learn about the trade ideas before everybody else who's just simply watching the free YouTube version later on that night. So that will be another thing our premium subscribers can look forward to going forward. And there's a lot of other things. You know, one of the things that we learned this week is that our old employer has started shutting down some of their products, including the video that David started when he was over there. So that will no longer be held along with their morning show that they have over there. So I know there's going to be people that are probably looking for a home. Remember, David and I would welcome you in. We, in fact, love to have those relationships with students, meaning that we have chatting capabilities in our classrooms. And so if you want to kind of learn more about the markets, but do it in an environment where it's a healthy learning environment where you get to associate with not only the coach, but your fellow students that are also very knowledgeable, and you want to feel like you're not doing this alone, then we would welcome you in. I think it's a great experience for that, and I think you'll really enjoy the students that we already have on board here at Market Scholars. Now, lastly, I wanted to bring up a tool that I've been working on here recently that will also be available exclusively to Market Scholars premium subscribers. But I do want to at least give you a sneak peek of it here tonight, just to give you a sense of what that will look like. But this is what I call my sector selector. And this is based off of a number of different rankings to look at the 11 sectors out there in the markets. And what I'm doing is I'm ranking the sectors by a variety of things, including 52-week high percentages, 3 green arrows percentages, bullish market forecast posture percentages, 1040 crossover percentages, 3-month percentages, 6-month price percentages, money flow, CCI, rate of change, RSI. And I think that pretty much covers us. But the point is, I'm basically looking at the sectors from a variety of angles to get a sense of where the true strength of the market is right now. And so that's what we're going to be looking at in my classes, especially my top-down trend trading class every Monday, will be this sector selector. Now this, what you're seeing in front of you, is just the top half of that. This is just showing you the sector rankings right now. There's going to be a bottom half of this as well, where we're actually going to derive our trade ideas. We're going to be looking at stocks that are hitting new 52-week highs and new 52-week lows, and looking at various characteristics, whether stocks have income characteristics, growth characteristics, or value characteristics. So a lot of you are interested in finding a top-down analysis tool. That will be yet another reason why signing up with Market Scholars could be in your best interest if you want exclusive access to this data on a weekly basis. But as you can see right here, let's now take this home and drive it into our trade application example for tonight's video. As you can see, according to my rankings as of tonight's close, we do have energy on top from a sector perspective. Now, keep in mind what I just mentioned here a little bit earlier, that crude oil prices were surging in the first half of the year. We did have a little bit of a pullback in crude oil prices here a few weeks back, and that's exactly why you see energy here kind of dropping from the second slot all the way down here to number 7 before recovering back to number 1 here a couple of weeks later. As you might guess, most energy stocks are driven by whatever's happening with the price of oil. So if the price of oil is volatile, sometimes you'll see volatile action within those energy stocks as well. That one is maybe not as big of a surprise because we've seen energy stocks doing well for much of the year. You can see that green kind of tabbed line has been strong in the upper zone for much of the last several weeks. But maybe more of a surprise is how well real estate and utilities have started to do here recently. You can see both of those have kind of surged from the lower portion of our ranking system here in May towards the top of where we're at right now. Generally speaking, in my classes, we're going to be looking for opportunities within the top 3 sectors in that Monday class that I referred to. So that's why those lines look a little bit bigger than the other ones, because that's where we're kind of pushing our attention towards in our class. But that's kind of a surprise, because I don't think a lot of people are talking about real estate stocks or utility stocks. But again, that's a bit of a macro story there with interest rates and the yield curve that I mentioned before doing what they will. We have the financial stocks with all those banks near the bottom right here, and we find those other interest rate sensitive areas like real estate and utilities near the top. So maybe some areas to hunt for in there. So anyway, I wanted to give you a sneak peek of that tool, because I know a lot of you are still sitting on the fence on whether you're going to sign up for us or not. I wanted to make sure you were aware that we have tools to support our investing decisions in our premium classes as well. So speaking of the energy space, let's now go and place our trade application here for the day. And so I'm going to come over here to just regular chart 4A for our market forecast chart again. And I'm going to pull up NOV. This is National Oil Well Varco. Now notice here, NOV was in a bearish posture here for a few weeks of time. That's why that background color is in that pink shading right there. But notice just here within the last 24 hours or so, we went back to a bullish posture on NOV. And even when it was in a bearish posture, it's not like it was falling out of bed. I mean, we saw a lot of energy stocks really taking a tumble during that time period. This one actually was quite resilient despite even having some of that bearish posture right there. So there is interest from investors in this particular name. And as I mentioned before, the energy stocks on the whole, from a sector perspective, seem to be doing better than most of the others out there. So what I thought we would do here today is what's known as a bull put spread. And so I'm going to come over here to the trade tab, and I've pulled up NOV as the ticker symbol right there. And I've got, let's see, let's take a look at August here. 21 days left in July. That's not a whole lot of time left. Especially since we got the weekend coming up. So we're going to go out to August on these. So be careful there. I know we're going into earnings season, but remember, when you are doing things like spreads, one of the nice things about them is that you can define your risk. So it allows you to maybe be a little bit more brave through earnings than you would have been otherwise, because you know what your worst case scenario is when you're setting up your trade. So we're out here in August with 49 days left. We usually look for that time period between 20 and 50 days. I like to stick with the monthly contracts when I can, because they usually are a little bit more liquid. So over here on the put side is where I'm kind of focusing my attention on the right-hand side here. I'm looking for a delta of about 30. So you can see that we've got a delta of 28 right here, and that's your 41 strike put. Current bid is 90 and current ask is 95. I'm going to go ahead and right-click on that, and I'm going to go to Sell Vertical. And that's going to give us a credit of about 26 cents. Now this is a $1 wide, so we're selling the 41 put. We're buying the 40 put, and that's creating a net credit for us to start the trade of 26 cents. And of course, you know, you're going to apply however many contracts you would normally do for your account size. But the point being, when we get a 26 cent credit, no matter how many contracts you're doing, you're going to get a return on risk of over 30%. So if we get our calculator out here, and let's go to confirm and send just one time. Not clicking this in yet, but I just want to get the max profit. If we just did one contract, 26 divided by max loss, 74. Notice that our return on risk is about 35% in this particular case here. Now, notice that we would be selling the 41 strike here. Of course, we're getting 26 cents worth of credit, so our break even is you know, about $40.74. And so anyway, if we came over here and looked at that on the chart, 40.74 would be right around this area. So notice that that is our break even. In other words, we need the stock to stay above this area through the life of the trade, if at all possible. So what that's going to require, if that does not occur, is for the stock to come down and breach this kind of strong level of support that we established here from mid-June to the end of June right here. So again, that's the trade idea for today. Let's go ahead and place that trade. Confirm and send, and off she goes, and we'll see how that one does going forward. All right, well, I want to thank you for joining me here tonight. Again, it's been fun to get to work with you guys here over the last several months. I know I'm going to get a chance to work with many of you at our premium services in the months to come as well. Don't forget, Saturday at midnight, our discounted offer does end. No exceptions to that rule. So if you are planning on joining us, please do it today. Don't wait until next week, because I'd hate to have you have to pay more money if you knew about it ahead of time. So make that decision. If you have any questions for David or I about our program or what you can expect, you can reach out to us at support@marketscholars.com. So with that, I want to wish you a great weekend. Best of success with your trades and your investments. Goodbye for now.